Hello, everybody. Jeremy Finger, obviously Riverbend Wealth Management. What we got here today is we got John Nichol, certified financial analyst with Stratus Investment Management. He's chief investment officer there. He's been in business since 1992. You could tell by the gray hair in today's market. John's previously worked with Federated Funds for almost 20 years and with Equity Bank and Trust.
Public Employees Retirement.
And yeah, and then okay, yeah, perfect. Welcome, welcome. And then we got Malcolm Polley is Chief Market Strategist, and he started in the business on Black Monday in 1987. That's October 19th, if I'm not mistaken.
Yep. Well, and he has gray hair too, but you can't see too much of it.
I've got a little bit of salt with my pepper, okay? And then bald spot. Okay. All right. So everyone, thank you for attending. If you've got questions, put them in the chat. If you have an issue with that, please let me know. But just ask your questions there. And so I know everybody wants to know, top of mind, guys, so tell us a little bit about tariffs, what they're for, what the pros and cons are, and your thoughts.
So tariffs are an interesting topic. It's not like they have not existed. When the United States has had tariffs in one way, shape, or form since our existence. In fact, if you go way back, the United States government funded itself primarily through tariffs. So there have been three large periods of time in history where tariffs were kind of the issue. The first was up until, let's call it Civil War. When tariffs were the only means of funding the U.S. government, that and a small amount from the sale of land, and that's being as the country extended west, they would sell land. From roughly the Civil War until about 1913 or thereabouts, when the income tax came into play. Tariffs were no longer the sole source of revenue, but they were still a major source of revenue for the U.S. government. And also had various excise taxes. So the U.S. did not have an income tax, I want to say, until 1913. I forget the date. That began a new period in our history. And at that point, tariffs, while they were still a source of revenue, went from being, if not the largest, one of the largest sources of revenue, to being by now basically an afterthought. What people remember, I wouldn't say remember is a loosely defined term. What people are concerned about today is that the tariff regime that the Trump administration is putting in place is equivalent to the Smoot-Hawley tariffs. And if you don't, that name doesn't ring a bell. The Smoot-Hawley tariffs were one of the reasons for the Great Depression. And they kicked off a global trade war. That coupled with a number of things like the Federal Reserve going the wrong direction on interest rates and some other liquidity issues and a bank panic going on at the same time. That's really all of that together created the Great Depression. But tariffs as a revenue source has been around since the founding of the Republic. The other side of that is that the assumption is that we're going to raise lots and lots and lots of money through tariffs. And you have to think about, what is a tariff? Well, tariff is, by any other name, is a tax. It's a tax on goods and services brought into the United States that are manufactured outside of the United States. And so it's a tax. So it's essentially a tax hike. The likelihood of raising $1 trillion in revenue on an annual basis from tariffs is exceedingly small for a lot of different reasons. Simply because the first one being is the rate we would have to raise tariffs to raise $1 trillion in revenue for the U.S. government, it would drive the world into a global tailspin. And I think that's probably one of the concerns.
Okay. Now, how much do you feel that they would raise from tariffs?
Several billions of dollars. I mean, when he raised tariffs his first administration, there were billions of dollars of tariffs raised. It is a rounding error on the federal budget's revenue streams. It will cease to be a rounding error, but not much more than a rounding error, even increasing the tariffs to where they're at where they would like to increase them to. So it will be a source of revenue and not unsubstantial source of revenue, assuming that imports remain the same. And it's kind of interesting if you look at imports, which if people are thinking about it, that would have happened anyway. Trump is upset with the balance of trade tilting away from us. The reality has been we have been a net importer of goods since the 1960s. In fact, since World War II, there have only been 2 periods of time where we've exported more than we've imported. So to say this is a recent phenomenon simply is not rational relative to history. The other side of that is that the last time he raised tariffs, you saw an increase in imports relative to exports. Why? Because people tried to anticipate the tariffs and load up on inventory prior to them hitting. The exact same thing happened now. Is December of last year, January of this year, imports went through the roof relative to exports because people were loading up on inventory, not knowing what those tariffs are going to be.
Hey, Jeremy, I did want to put, one little thought in here that when Mal talked about the 30s, one thing that's also interesting, the U.S. trade balance was much more balanced then with imports and exports.
Yes.
So when people say you go look at that area, now it's completely different where we're a massive importer compared to the rest of the world. So it's a different, it's almost comparing apples to oranges, someone's.
Yeah.
All right, that's a good point, meaning that is collectively the net effect to us would be way different today because we're importing a lot.
Yes.
Versus a
Yeah.
lot less back in the 1930s.
For example, if you think about it, think about the one product you use the most every single day, this thing, cell phone.
Okay.
We have not manufactured a cell phone in the United States since 2017. So every one of these things is going to have a tax put on it, anywhere from 10 to what's China, 65%.
It might be going higher.
Might be going higher. So you're going to have a tax put on cell phones, and cell phones run what, $700 to $1,500, depending on what you get. So you think of double that. Are you going to will be willing to pay $1,400 to $3,000 for a cell phone? Some people certainly will, and some companies are already trying to find ways to minimize that impact. I think Apple announced today that they were going to try and source U.S. cell phones through India, which is going to have a lower tariff regimen than the U.S. does. So it's simply a tax, and there's a lot of items that we don't make in this country. Televisions, for example. The last U.S. television manufacturer went bankrupt in 2007. So there are a lot of products that we use every day you can't get made here.
Okay.
The other thing I think I just want to bring out about that is who pays the tax.
Mm-hmm.
So think about it. Apple actually might pay some of that tax themselves, which hurts their margins, but they might not raise the price. They might not fully put that in. So the question is also, if you don't buy a cell phone, then you're not paying that tax. If you don't buy a truck this year, then you're not paying that tax. So there is some. It's not what I would say a tax that's across the board for everyone. It's sort of selective. I hate to say it. It's almost like the VAT tax that you hear he's fighting about.
Very much so.
With the Europeans.
I haven't heard that before, but that's absolutely what it is. Like in Bulgaria, and over in Europe, there's a VAT tax.
Yep.
That they have. I can see that would be the case. So the tax really is could affect the consumers of products that are primarily manufactured overseas.
Yep.
Okay.
Or not even primarily manufactured. Take an American-made car, for example. If you look at the content of a U.S. manufactured car, I think it's more than half of the components that go into that vehicle are actually manufactured outside of the United States.
Okay. Does that mean that they're going to have a higher cost coming in?
Definitely. Either a higher cost or they're going to have to eat some of that and margins will be smaller.
Okay. All right. So next question. Why? Why do all this? And what would be the net benefit presumably there is a benefit, and what's some of the repercussions if it doesn't work? I mean, kind of give you the pros and cons here.
So the why is that there are a number of people that believe that trade that happens quote unquote disadvantages the United States is bad trade. Okay, so the fact that we're buying all of this stuff from overseas and they aren't quote unquote buying things from us is bad for us. And they have gutted our manufacturing system. So let's start with manufacturing, for example.
Okay.
We have lost lots of manufacturing jobs, and they tend to be at the lower end, less efficient jobs. And from an economic perspective, what you tend to do is try and get to the most efficient, try and become as most efficient as you can. So if you are a manufacturer and you're really good and efficient at taking components that are made somewhere and putting them together and shipping them out the door, but you're not so good about making the components, you want to source those components from the lowest cost provider possible, consistent with high quality. More and more of that has been shipped overseas. For example, the shirts that we're wearing today. The United States used to be a leader in textile manufacturing. But I would be amazed if anybody puts on a shirt today that says made in the USA on it. Most of them are made in Bangladesh, Vietnam, India, other places. And it's simply because the cost to produce a shirt of equivalent quality to something that's made in the United States is dramatically lower. Can you imagine the cost of a shirt if you take that manufacturer from somebody that makes $3 an hour to the United States at, assume union scale at 20, 25, $30 an hour?
Yeah.
And the efficiency differential between the two? I mean, the cost to produce in the United States a shirt, instead of costing anywhere from 30 to 80 bucks a pop, is going to run you 90 to 150, $200 a pop.
Okay. So, all right, let's say that's true. Okay.
Mm-hmm.
And I can see that being true. If you're talking about the tariff revenue being billions of dollars,
Yeah.
not a trillion, but billions,
Mm-hmm.
that the amount of in our economy, what is it, 16 trillion a year? Something like that? What's the government?
Something like that.
Okay. As a percentage, it's not that much.
No.
Okay. So
And trade has been a net drag on our GDP for decades. But it's a rounding error.
so not that big of a deal.
No.
Okay. With that being said, is the market overreacting or what?
No. I'm just
Okay.
trying,
Tell me
it's funny
why.
because I happen to be thinking about a lot of this. I'm trying to put this into words. So if you think about it, start with the fact that a tariff is a tax. A
Yeah.
tax raises the cost. The cost is going to be paid either by the manufacturer, which is a producer cost, or the consumer, which is a consumer cost. So if it's consumer, it all flows through CPI eventually. The PPI increase that's paid by the producer, he or she's going to have one or two options with that. They can pass along the entire cost to their end user, in which case it doesn't cost them anything, but they might see sales come down, or they can pass along, say, 50% of that added cost. Where does that other 50% come from? Right out of margins.
Yeah.
So
Yeah.
if we
So,
were
okay.
already
So,
in a market that was priced for perfection, and you reduce margins by 50% or 20% or whatever, then you shouldn't be buying stocks based on a 22 multiple. It should maybe be 16 or
okay.
12.
Okay.
That's one of the issues. The other one is going to be how much are higher taxes going to impact growth, GDP growth? Well, higher taxes have a pretty good correlation. The higher the tax goes, the lower the growth goes. So if this is a higher tax, growth is going to come down as well.
Okay.
In part because prices have gone up and we don't want to spend as much, and we'll tighten our belts. Um,
Okay. So what you're saying is that the tariffs are a tax.
mhm.
Is there talk about having taxes reduced or bringing inflation down as a way to offset some of this?
Well, it's interesting because one of the things I've seen that people are just kind of amazed at is that as tariffs have gone up, the dollar has done something nobody expected. Everybody expected if tariffs went up, the dollar would go up, but it didn't. The dollar went down. And from a Trump's perspective, he's not a huge fan of a strong dollar. A weaker dollar actually, in some respects, helps make his argument for him. So a weaker dollar. I got to run through this again. It's turned out the opposite of what he thought it might. So if we had a stronger dollar, then it would actually reduce the cost from overseas to a certain extent. But in some ways, the weaker dollar has actually exacerbated the inflation issue. So I don't know how you bring inflation down. You have to bring inflation down through lower costs somehow, or higher cost of money,
Right.
which is the mistake that the Federal Reserve made in the Great Depression. They hiked rates in the face of an economic problem.
Okay. So do you feel like they may lower rates now? You don't know?
Don't know. The Fed
What
has,
we,
go ahead.
okay, what we've seen in the futures is that there's 2 rates coming this year for sure, with
Yep.
a third pending. So that's probably, I would say, before Liberation Day or before this pullback, I would say there was probably expectations of maybe 1 cut. So I would say that there is some belief that the Fed, I don't know if we'll come to the rescue, but will potentially cut. But they have a little dicier situation because tariffs cause sort of short-term inflation, and that's why the 10-year fell, but then it sort of stabilized to around 4%.
Yeah.
Okay. Now, oil has dropped some. Would that be less inflationary? And
Yes.
It's a positive.
Is that related to tariffs too?
Yes. It's interesting because I remember I've had this conversation with somebody else recently, is that oil, if you think about it, oil is a global commodity. Natural gas is a local commodity. So oil prices have come down, and that's in part because I believe OPEC Plus has said they're actually going to increase production dramatically higher than they were expected to increase it in later this month, right, John?
Yeah.
So higher supply, demand roughly the same. Basic economics says price has to come down. So where are we going to find that price at? I don't know. Energy companies in the United States kind of got religion the last time around because they didn't care about profitability. It was drill, baby, drill. And now they realize, hey, if our cost of capital is X and we're pulling oil out of the ground at X plus, we're going to go bankrupt pretty soon. So they have capital, actually, they pay attention to their capital costs. You have capital discipline now. But natural gas is more local. So you look at gas prices, those may not be you might not see such wild fluctuations in the price of natural gas.
Okay.
Because we source most of our gas internally.
So with tariffs being inflationary, so what it would be any other comments on inflation in the, let's say, middle term, as far as inflationary is concerned, with money being pulled back out of the market, so to speak?
Well, I'll take a stab at this, Mal, and you can join in. What I would say is when we looked at remember 22, inflation was at 8-9%. We were calling for inflation, to come down to the 4-3%. That was the easy call, but we said the Fed was going to have trouble getting it from the 4-3 down to the 2. That's their stated goal. And so even before the tariff issue, which the question is actually funny. I don't know if you've heard, they've mentioned the word transitory again. They've mentioned inflation being transitory. They mentioned that in November of 21, but this one truly might be, because you think about it, a one-time tariff increase only increases the price of that Ford truck for 1 month. Then it doesn't increase it anymore. So it'll be interesting that it makes the Fed's job much more difficult because inflation will become more sticky in the short run if they need to cut something because there's a slowdown in the economy.
Yeah, and it's interesting because the Fed keeps talking about this 2% goal, and if you look at the dot plot, which is their summary of economic projections, that one that just came out with their March meeting, they're still saying they can get inflation down to 2%. And it's kind of incredulous. It's kind of incredulous because if you understand where that 2% number came from an offhand comment made by a member of the New Zealand Central Bank,
right,
when he was being asked about where would you like inflation to be, and he said 2%. There's no data behind it. There's no historic precedent. In fact, if you look at the U.S. Economy, our average inflation rate's about 2.5. That's a more logical number to shoot for, but we still seem to be intent on shooting for 2. If we are shooting for 2, then in my mind, what happens is you end up with subpar growth because rates have to be higher than they otherwise would be. So I think what the Federal Reserve may do is say, we're at 2.5, 3. That's good enough. Then they can sit back and say, okay, we've got issues from a market perspective because of tariffs. Now we can afford to ease a little bit, but they've got to make that transition. And I think they did that in some respects when they reduced the quantitative tightening that they were doing. So they were letting 25 billion in maturities come off their balance sheet every month. Beginning this month, it goes to 5. That's not a quantitative easing, but it's a reduction in the quantitative tightening, which is
what?
part,
Which is what?
It's kind of a backhanded, I guess, easing, if you will.
It's a positive for the market.
Yeah.
On the investment side. So, I would say a couple positive for the market here. Oil prices have come down. Interest rates have come down a little. I think the other thing, so there's a couple aspects that are out there that can be long-term, deemed as positives for the market. But the biggest one we're looking at is uncertainty. Because the uncertainty caused by the tariffs, what does it do to the consumer, which is what 70-80% of the spending? Ask your clients, are they going out because of tariffs, are they going to stop spending? Then we might have a problem. Or think about the businesses. Are they going to stop spending or doing their CapEx because of tariffs? Then we might have a problem. It might be pushed back or put on hold for a month or two here, but that's sort of the question we're trying to decide. That's the question. If those two, the consumer group and business stop spending, we will go into recession. Right now, we're sort of thinking we plod along the bottom of the line, but don't go into a recession.
Right.
That's what y'all's base case is?
That's our base case. Yep.
Okay. Is not going into recession. We may plod along.
Right.
Okay.
But there are some, go ahead.
So if you look at the last major recessions we've had, they are either events, i.e. COVID, or there was a major liquidity crisis. Well, we don't have COVID. So the other option is a major liquidity crisis. And I don't see the trigger for what that might be. I mean, the Great Recession, it was a home ownership rate that was, more than 3 standard deviations from the mean. We were lending to people in a mortgage side that we had no business lending to, we being a generic term.
Right.
During the .com era, it was a liquidity crisis created by companies that were going public on a hope and a dream. They had taken the CapEx spending that was happening in 98, 99. It was happening because of an event, Y2K, and extrapolated it into the future as if it was going to happen, and it didn't. And you had some companies go poof because of it. You had long-term capital management. You got a lot of liquidity issues that create an economic recession.
Diversification worked in year 2000, 2001, and 2. By the way, for those of you who don't know, I started in January 97. Okay, so I was, so it worked. And so, all right. So that being said, where do you see opportunities and where do you see risk going forward?
You
I'll
want to
I'll
take a shot at
start.
that, John?
I'll start. So I guess let's just talk about earnings and talk about multiples, and we'll sort of give you a macro view of where the S&P is. So currently the S&P's, where are we today? We're at 50-50. The way we sort of try to look at the downside, upside sort of potentials of the market, like a risk reward ratio. So when we look at average high multiples with a positive earnings number, we get a upside target price in the S&P around 6,200. So, almost a thousand points up. Unfortunately, if you look at a more recessionary-like environment for the U.S. and low multiples, you get about a 4,000 to 4,200. So you basically get $1,000 downside target price. So your risk reward is basically 1-to-1. So then you have to sort of wait. Well, which ones do you think is going to happen more? As you've heard us say, we don't think we're going to go into a recession when earnings is actually negative. We're thinking low single-digit earnings growth for the year. That means a downside might be like at 4,500, and if we're at 5,000 now, and you have an upside of 6,000, your risk reward ratio starts getting a little positive. So overall, we are. I don't know if you heard the clue Mal said in the very beginning: price for perfection. When we entered January, we were priced for perfection. 15% earnings growth with a 24 times multiple. Where we pulled back on the earnings growth, we pulled back on the multiple. So there is some protection just from the pullback that's happened. So I think there's various sectors that we obviously like, but that's sort of I give you an overall picture of the market.
Okay.
Yeah. And I think that from what we've been telling people for more than a year now is that stay away from the areas that you got obvious in our mind. You're extended. So we've been saying in the S&P 500, look at the other 493. So if something doesn't work out as you thought, you don't get hurt nearly as bad. Tesla at whatever multiple it was at a year ago, did it make sense? What happens if NVIDIA's growth doesn't come through as expected? So there's a lot of what ifs that needed to work in your favor for that to make sense. So it just made sense to us to focus on the areas that were not nearly as extended. Looking at from a market perspective today, what areas are going to get hurt worst or hurt the most in the current tariff regime? Anything having to do with China and other parts of Asia. So you probably want to steer clear of, unfortunately, there's a lot of tech stuff in there. Doesn't mean everything is included, so you have to pay attention. But, steer clear of the obvious areas of dislocation. And what I've been telling people for a long time now is pay attention to your risk. People spend too much time focusing on the return and they forget that there's risk associated with it. So
Not my clients. No, I think my clients are pretty in tune with the risk.
that's a good thing. I mean, I
know.
But days like we've been having over the last few kind of forces beat people back in. It's like, oh, you mean we have this thing called risk we have to worry about? So paying attention to the risk that you're taking, and don't get out over your skis from a risk perspective.
Yeah. Now, I mean, you don't have to say individual names, but strategically speaking, like, are y'all allocating towards particular defensive areas more now than you were previous? Or like, how are you guys thinking about y'all's asset allocation in light of the, market volatility and all that?
I'll go with this. So what I would say with that is, since we thought we were priced for perfection beforehand, we tended to be a little more conservative in some of the exposures. We were underweight NVIDIA, so that names like that were the high flyers, we were not aggressively in those names. Right now, we're constantly checking the consumer and constantly checking businesses if they're going to continue to spend. If business is going to do CapEx and consumers are going to spend. If that's going to happen, there is no recession, which probably means we will probably look at more normalized type stocks, not your utility companies, not your staples, because they have massively outperformed in the last 3 or 4 weeks. So for them to continue to outperform for the rest of this year, we have to have a recession. And we're could it happen? Obviously, it could happen, but we're just not seeing it now. So we're looking at names that have reoccurring earnings that maybe aren't your per se. I mean, that are cable companies, streaming companies, stuff like that could potentially look interesting. We're actually looking for companies that have positive risk reward ratios. Like I was talking about the upside down, we're looking for 3-to-1s. And believe me, there's a lot of 3-to-1, 4-to-1 risk reward ratio in individual companies across the spectrum right now. I would say like energy stocks, we are a little worried with oil prices and the slowdown and the output. So that means could be an issue with energy stocks per se. Retail could be a little interesting, problematic if consumers stop spending. So there's areas that we're looking at across the board to see, what happens.
Okay.
Yeah, and I'd say from my perspective, there are sectors that I think make a lot of sense from a longer macro perspective. Energy X oil and gas, from electricity generation. We are way underinvested in the United States on our energy infrastructure, and simply to keep up with demand, we're going to have to make massive investments in that area. So there are places you can invest to take advantage of that. And for the first time, I'm actually in a long time, I've actually seen some companies pop up on the screens that I look at that are old Ben Graham net current assets companies. So they're trading below not only net current assets, which is current assets minus current liabilities, they're trading below the cash minus current liabilities and debt. I don't see that very often, but that tells me that there are opportunities out there.
Yeah, maybe people are throwing out the baby with the bathwater, so to speak.
Yeah.
Okay. All right, good. Hey, now I know the people listening to this are not shy. Okay. Type in your questions, and you can choose. I think you can choose the drop-down menu and just choose my name and send it directly to me if you don't want your questions to be let other people see it. But whatever question you got, there's no dumb question, none. So please ask questions. Okay. So
Hey, Jeremy. Oh, go ahead. I was
no.
I was gonna answer your question. One time you mentioned, so why tariffs? And and the way we sort of look at that is, if you look at what happened in 2020 with the supply disruptions, there was a lot of onshoring back to the United States. So there's that whole issue. I just saw a statistic that said there's only one steel blast furnace in the United States that does coiled tubing. So if we ever had an issue like a war, we couldn't really fight because we couldn't produce any steel. So there's issues like that. And then on top of it, there's the big populist issue that, President Trump's got along with, who's made the money over the last 30 years, the owner of Netflix, the owner of Amazon, the owner of Meta, and who's been hurt? The factories that have closed down in the flyover countries that maybe now, I don't think people should think you're going to get that new factory opened up and it's going to have the 10,000, 20,000 jobs that it did in the 70s, because it's a lot more automation, but you might get 5,000 jobs or 2,000 jobs that are good paying jobs that weren't there beforehand. So those are sort of some of the reasonings.
Yeah.
Okay. So kind of reshoring back some of the jobs that may be lost.
Which was going to happen anyway. I mean, COVID really, what it exposed the supply chain to was the real problems of just-in-time inventory, particularly if you're sourcing from one geographic location. So your onshoring has definitely started happening. And it started out as nearshoring, which meant Mexico and Canada.
Okay. Yeah. I mean, I could see how that would make sense. Yeah, you have more control over your entire supply chain. However, your cost of that could go up because
that's the yin and yang of this. For example, majority of pharmaceuticals subproducts are made in China. So if China all of a sudden said we're not going to deliver anything to the United States in pharmaceutical land. I've heard about half the drugs being made by the big companies wouldn't be there. So people wouldn't be able to take their blood pressure medicines, wouldn't be able to take their weight loss medicines. So it might be worth paying some a little more so we have the security knowing that it's there.
Yeah.
Okay. All that being said, where we're trading right now, as far as multiples are concerned, in the see y'all leaning towards not having a recession. What would be y'all's, and I know this is like thumb in the air type of thing, chest to wins, but projections on the rate of returns of the equity markets, let's say over a 3 to 5 or 10 year period.
I'll start. You want me to go first? So
no, go ahead.
actually, you should probably tell your clients to look at a couple of the pieces that Mal's put out over the last couple of months, and one of them was sort of forecasting the next 10 years when we were priced for perfection, and he was basically saying potentially low single digit. So that's our expectation for equity markets, which is sort of shocking because we've been up 25% 2 years in a row. And for us to tell people, hey, it might be a little tougher going on, I think that number has creeped up a little just because we've pulled back, anywhere from 15 to 25%, depending upon what index you're looking at. So that's sort of one of our thoughts.
Yeah. So longer term, I know was it Goldman, I think, kind of lit a fire under everybody when back in September, October, they said that over the next decade, we're only going to get a 7%. I think it was 5 to 7% rate of return from stocks because of yada, yada, yada. I thought that was a bit silly because they're really the only time in our history that our average return on equities has not been 10% or above was really in the period of the Great Depression. And barring an experience like that, it's very difficult to get rates that was, well, let me back up. To get rates that low in a 10-year period, you need to have at least 3 years where you've got high single digit, low double digit negative returns. Okay. So Great Depression, the only other period was 2000 to 2010.
Yeah.
Okay.
And you had 3 down years to begin with, and you had 2008 was
so
a big
5 to 7 over a long period of time.
Yeah.
You have to assume some really bad things happen, which I
Right.
suppose is possible, but not probable in my mind.
Okay.
So I think
I'm
I think
sorry.
the average return, it's probably not going to be 12% we've had for a lot of different reasons, but it's more likely in my mind to be in a range of say 8 to 10 or 11% than it is to be 5 to 7.
Okay. Fair. And for those of y'all listening, the stocks are just one component of many.
Yeah.
You have bonds, you've got cash, you've got Social Security, some of you got pensions, and taking the collective of all of those different things to try to optimize as best possible y'all's income, and to be able to generate that retirement. Now, all that being said, is that I've had clients who retired well before the year 2000 and they're still retired today. So they didn't have to go back to work. So, there's a lot to it on generating that income versus just what happens. I'm pointing at the TV over here, that happens to the stock market. So,
I see you have a question out there, Jeremy.
I do. Oh, yeah, I do.
It says, is there any concerns this sell-off could lead to a more serious liquidity crisis in the credit markets or hedge funds? That's actually something I've been looking at because I'm kind of looking for where's the problem, right? Hedge funds and credit markets. Hedge funds, I don't think you have the problem there as much. In credit markets, you got to think, okay, where are you overextended? Where are you over your skis? In the Great Recession, it was mortgage. That was clear. You could look at consumer credit. Now, consumer credit is high and delinquencies are coming up, but relatively speaking, the consumer today is in much better shape than it was prior to the Great Recession. You can look at business credit. Well, businesses also in many cases are in the best financial shape that they've ever been, even though the average credit rating for a corporate bond today is BBB, which is the lowest investment grade. Businesses refinanced when rates were zero, which is what you do when rates are zero. You bring your cost of capital way down. Small companies don't finance themselves through the bond markets. They do it through banks. So you need to pay attention to bank liquidity, which could be a problem. But banks are in the best financial shape that they've been in since I've been in the business. Capital ratios are much higher than they were in the Great Recession and dramatically higher than they were around the turn of the century, which seems really odd to say. One area that I'm looking at, and I don't know where to find delinquencies, I can only find the absolute level of debt, is margin debt. Now, FINRA, New York Stock Exchange used to keep track of this. Now it's being done by FINRA. FINRA does a monthly report that provides the absolute level of margin debt in the market today. It peaked in January at $937 billion, so almost $1 trillion, and has come down for the first time in, I think, 6 months. In February, from 937 billion to 918 billion. Don't know what that means other than it's very high. But what I can tell you is, if you get a big dislocation, like we've had in some respects over the last 3 days, and you got lots of margin in your account, you could be subject to a margin call. So what I don't see, and I can't find, is how much margin does that margin debt represent? I mean, relative to the value of the account.
Yeah, how close to a capital call would they have?
Exactly.
Exactly. Yeah. All right. So what that means is, let's say, for instance, you had $1 million and you borrowed 500,000, and then your $1 million started dropping. There's a point in time where the custodian would force you to sell and these stocks to pay that margin off. Okay? Mm-hmm. That's what Mal's referring to and alluding to. And I'm just going, yeah, I mean, as far as my people are concerned, we're fine, but in that regard. But yeah, it's an interesting take that the level of margin debt would be an indication of some speculation.
Yeah. So you say something, John?
I was just going to say that on the aspect of stocks, we're probably a little more worried about the new finance companies, whether it's the KKR, the BlackRock, the Apollo, because basically when 08 happened, regulation came down hard on your standard bank, especially your large cap bank, and some of that capability left the banks and went to those type companies. So when the gentleman or lady was asking about risk, the risk might be that one of the private equity or private credit firms that has grown up tremendously in the last 10 years has a problem. But that's something that's not seen in the market overall. I would say go ahead.
I'm saying I don't think it provides a systemic risk like it did in the banking
industry. Because I would say the other factor we're worried about is the dollar. That used to be the dollar is king. The dollar is the world currency. President Trump is trying to change 40 years of trading aspects. Maybe that means there might be a change in who's the world currency. It hasn't happened yet, but right now we get a lot of benefit from being the world currency.
Right.
Yeah. Another question, and a lot of people have this question, is that, hey, why not pull the money out of stocks and get 4.25% and then wait till things straighten out?
It's actually I actually got that question earlier today from a reporter.
I'll give you one story potentially why. That's close to market timing, and there's historical studies that in psychology studies that market timing doesn't work. I know of at least 4 clients that pulled their money out in April of 22, and their money is still not in the market.
Yep.
Because they missed the rally. You missed the first 6 months of the rally. You go, oh, I'm going to wait. It'll pull back. And then it doesn't pull back in 24. or 23, and then it doesn't pull back in 24, and then they've missed, up 60%.
Yeah.
But if you can perfectly time it and be disciplined, there is something to that. But that's very hard. Let me put it that way.
Yeah, because you have to make two correct decisions, which is very difficult. You have to make the correct decision to get out, and you have to make the correct decision to get back in time. And if there's one thing we've learned from the last couple of dislocations, is you can't get back in time. I mean, the COVID sell-off and the sell-off in 22 because of Silicon Valley Bank and First Republic, et cetera. I thought, and I'm imagining John and his group thought the same thing, because I've only been here for a little over a year. Hey, I got plenty of time to get money back in the market. Wrong.
Yeah.
I've been in this business, as you said, Jeremy, since Black Monday 1987. So coming in on 40 years, which just boggles my mind. In my entire career, there's only been one time I raised cash in my portfolios, and I've taken more flack over that decision than just about anything I've ever done. And that was going into the Great Recession, actually. We had a big exposure to mortgages. And so a year leaning into it, we started seeing some cracks in the mortgage market. So we got out and didn't put it into anything because I didn't find anything worth investing in. And then we exited all indirect exposure to mortgage. In August of that year, we exited all consumer stuff. So going into October, I was sitting on 35% cash. But then you had to make the decision to find stuff, which is what we were actively doing. And by then, there were enough dislocations in the market that there was lots of stuff to buy. So by the end of that year, we were 2% cash. But you can't be getting out because you're scared. You have to be getting out because things are excessively expensive, and they're not anymore. And 4.25%, they might be paying that today. If rates come down, they're not going to be paying 4.25% anymore. And moving money out of an online bank isn't always that straightforward.
And the thing is, to get back in, oftentimes the best time is at the worst possible news.
Oh, yeah. You have to be willing to. So I'll give you an example. At the end of October 2008, I believe it was, Anheuser-Busch InBev was being acquired. Anheuser-Busch was being acquired by InBev. Okay. The takeout price was $71 a share. And that was happening like November 14th. The end of October, you could have bought Anheuser-Busch at $57 a share. Okay. Knowing that you were going to get taken out 2 weeks later, $14 more. And I say knowing because the financing was in place. They'd had all their regulatory approvals. They were just waiting for one last piece. They had the date that was going to happen out there. But a lot of people were ignoring it because they said something bad's got to happen. Well, the right decision then was to jump in hand over fist and buy as much as you could, because you were basically buying a very low risk investment. But I will tell you, there are a lot of people that never did that. The other example is mortgages. In 2008, anything mortgage was toxic waste, right? But there's a difference between mortgages and commercial mortgages. When mortgage-backed securities are very opaque, you have no idea what's in there. In a commercial mortgage-backed security, you can tell exactly what's in there, who's paying the lease, when what their escalators are, when the leases are due, when the paper inside the mortgage pays off. And again, in October and November of 2008, it was possible to find commercial mortgage-backed securities that were 100% defeased, which basically means the loans were paid off and the money was sitting in treasury bills, yielding double-digit returns.
Wow.
And that's simply because the security had the name mortgage in the name.
Yeah. And look, and that's the book by the cover type of thing.
Yeah. You have to be willing to step in when everybody is afraid to do so. And that is hard.
Yeah. And the thing is that the same fear that would cause someone to go to cash or do that would have to overcome that fear plus more at a time, because all the news is going to be negative at the time at the bottom.
Yeah.
So I'm going to share one story, and then again, if y'all got questions, type them in. I had two different clients. One client called me up, and this was in 2003, And he says, hey, I haven't made any money in like 4 years, right? And I'm like, what? That doesn't make any sense. I looked at his allocation. I'm like, oh, that looks good. And then I went back and looked at the notes. What he did was he sold all of his value stocks back in the 99 and bought all his tech stocks.
Mm-hmm.
And then when tech stocks hit the fan in the year 2001 and 2, he sold all his tech stocks and went to cash and then reinvested back everything in 2003.
Yeah.
So his net return was zero.
Yeah.
Similarly, a guy who didn't do anything, he just kind of stayed the course, asset allocation, rebalance, blah, blah, blah. His average return was 6% per year on average through
Yep.
that same period of time. And I'm like, thank God I took down a lot of notes. but
Yeah.
but it just goes to show is like you can almost be, I don't mean to say this in a very negative way. It's almost like a Forrest Gump sometimes to just do good things, stay the course,
Yep.
have your cash, choose your Social Security right, live within your means, those types of things. And you could ABC this thing and be okay.
Yeah. Yeah.
Yeah. Yeah. I say ABC.
It's
Yeah, we try to
it's
do the DEF and all the way to double Z
yeah.
guys with the tax planning and things like that. So
What I tell people, it's kind of weird to say it, and I've heard this quote a number of different times or different things, is what we do is not difficult. It's just hard.
simple but not easy.
And
Yeah.
it's because of up here.
Yeah.
Yeah, 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 definitely. Well, guys,
But
any other final questions? Final questions.
well, Jeremy, I'll just give final thoughts on my
Oh
side. So
yeah,
the
parting shot.
three things we're looking at. We're checking the consumer and his spending. What is he doing there? Because that will give us recession or not signals. We're checking the business side, CapEx. What are they doing? Did they pause? Are they spending, or what's going on in there? And three, the jobs and unemployment side. We didn't talk about it, but the jobs number was fairly decent on Friday. I mean,
Yeah.
so there is now, that's a little backward looking, so I'll give you that, but still it was a positive number. So those are the three areas, because
Yep.
jobs mean income means spending. And so those are the three areas we're sort of, our watchdog. So when your clients are seeing someone talk about a tariff, this, tariff, that, have them think, are there consumer spending? Are the business spending? Are jobs getting lost, or jobs, those are sort of the things we're looking at.
Yeah,
Yeah. And
I'm looking at
I would
full
echo,
employment.
I'd echo John's sentiment. I think jobs is something I've been focused on for a lot of years. And if you ask business owners, what's it harder to get, employees or business? And my guess is most of them are still saying it's hard to find a good employee. I will worry when that flips. And businesses say, I don't worry about employees. I got all I need and people are coming in the door that I can't hire.
Hmm.
But right now we got more jobs available than there are people to fill them.
That's a true statement. I mean, most people that I've been talking to is yeah. It's like if they want to work or even work part-time,
Yeah.
they're a decent person. Guess what? They're getting paid,
Yep.
and it's
Yep.
not like they're getting paid in in flour. They're getting paid in dollars.
Yeah.
They're getting paid real money because the company themselves are seeing them as value, and that company themselves is making money.
Yep.
Yeah.
Yep.
Yeah. Good.
So, and then I'll sprinkle a little politics on here, not much, but just
Sprinkle.
be careful with you've heard all this thing about the firing of federal workers. I hate to say this, but it's really a drop in the bucket. I mean, compared to the whole economy. I mean, so, and then the one last thing I want to say there is if people go back and look at the hiring patterns of all the companies in 19 and 20, there was a massive amount of hiring in employment. Then 22 happened, and basically the private sector fired everyone in 22. Well, what happened in 19 and 20 with the government? They spent and hired everyone, but they haven't done anything. They didn't do what the private sector did, cutting back. Maybe there's
Yep.
a little cutback coming right now.
Yeah.
Yep.
So maybe there's a little bit of fat to trim.
Yep.
Yeah. Yeah. And I'm saying this out loud to kind of to my son,
Better you than me.
out loud to my son. Like, if you want to have a job, be good at what you do, whatever that may be,
Yeah.
and you
Yeah.
hopefully won't be the one that's being cut.
Yep.
Yeah. And if you are being cut, then darn it, son, you better learn something. Learn how to do something
Skills,
about it.
skills.
Yeah. Yeah.
Yep.
Skills. That's right. And, be a good person, that kind of
Yep.
thing. There's one more question, guys. Y'all not off the hook yet. I get so excited when there's questions being asked. Is Riverbend looking and individual accounts relocating necessary? Oh, yes, absolutely. Okay. The question is Riverbend looking at individual accounts and reallocating if necessary based on the current situation? Absolutely. Absolutely. Okay. Great question. And primarily,
Hey, Jeremy, I'll take it one step further. We're actually looking for tax gains, tax losses. So if there's a loss in their portfolios, we will sometimes tend to sell that, incur that, get that loss so they can use it for their taxes, and then put it in something else. Like, for example, sell AT&T and buy Verizon. Sort of the same method, same companies, same drivers, but you get the tax benefit. So there is asset allocation and sector changes and individual stocks and funds all the time.
yes,
Yep.
great question. A little bit to just for clarity is that Stratus helps manage much of our clients' accounts, and these guys and their team is doing strategic things that they just discussed today. Whether that be, not avoiding oil companies and utility companies at these valuations and being a little bit more defensive in January, they're making those moves for you as that time goes on. Now, some accounts we have are not managed by them, but we have a different framework we're using that we are doing the same thing similarly. Okay. And that depends on a lot of different factors. But great question. Okay.
Yep.
And we're always thinking about this kind of stuff. And your taxes and your Social Security and all those different pictures. And that's what I know and love about you guys. Yeah. Good stuff, man. This is awesome. I say awesome. I know the listeners here are concerned about their investments, all right, and their retirement. This is why it's so very, very important to make sure that we understand your overall picture, which we really, really try to do. Make sure you have enough cash on the sidelines. Make sure that you optimize your Social Security, and have other smart decisions, tax-wise and otherwise, to be able to weather markets like this. Okay. And our software and things we do that show you how you can be retired and stay retired, take into account fluctuations just like this. Okay? So,
last thought. You gotta be careful because I always have last thoughts. We'll be here forever.
But John, you're full of great knowledge, buddy.
Asset allocation is key. It is the single most important thing. People worry about an individual stock. Do we own this? Do we own that? Do we own that sector? Jeremy, you working with your clients and setting the right asset allocation for the long run is the biggest driver of performance. The statistics studies, I think it's like 75 to 85% of their returns are based on the asset allocation. So that's the most important thing. I know we're talking about the markets and what's going to happen in the next month, but that's probably how they're allocated is probably more important even now.
Yeah, and John, sticking with the investment
stuff. That goes back to that one point about selling and getting back in and all that stuff.
That's right. And look, I say, you guys see that I'm lighthearted in this. And I don't mean to minimize the seriousness of fluctuations.
Right.
However, when you have things set up properly and you're looking at a 30-year investment horizon or life expectancy or 20 years, these types of things happen. They just do. All right. You guys are all sitting here today and you went through a 36% drawdown in 2020. And here you are, right? You went through what was the drawdown in 22? It was what was it?
Depends on 18 to 25, depending what you own.
And here you still sit, right? Sometime later in the future, we're going to be talking about today, and you will still sit and talking about this drawdown.
And we'll say, Tariff, what's that? No, just kidding.
Yeah, it's some other soup du jour into the future.
Yep.
Yeah, but I love you guys. John, Mal, love you guys. Love your clients. I mean, I love you guys. You guys reach out to us anytime about anything. Happy to answer any questions that you have. And yeah, and as things happen, we might ask you to come back, guys, because y'all were rock stars today. I appreciate your time.
Well, thanks for having
Our
us, Jeff.
pleasure.
Yep.
All right. Thank you.
Thanks.